Welcome to the Explainer. So, you're a young professional and you finally scraped together your first 50 grand. Huge milestone, right? But now comes the real question. What do you actually do with it? You've probably heard the fierce debates online. You've got property owners claiming that rent checks are the ultimate wealth hack, and then you've got stock market purists arguing for the unmatched power of index funds. Both sides are absolutely convinced their method is the unquestionable winner. But today, we're going to strip away the influencer hype, look past those catchy headlines, and break down what these choices actually cost in dollars, in time, and in stress.
Okay, let's dive right into our course syllabus for this explainer. 1. The $50,000 question. 2. Real estate, the second job. 3. Stocks, the invisible machine. 4. The 20-year reality. And 5. Exam review, evaluating risks.
Section 1, the $50,000 question. Let's set the stage. We begin with two identical 20-something professionals, Jake and Marcus. They both earn 55 grand a year, they live in the exact same city, and they have the exact same financial starting point. The only difference is how they decide to deploy that first major chunk of savings. Jake uses his $50,000 as a 20% down payment on a modest $250,000 rental house, locking in a 30-year mortgage at 7%. With $1,800 a month coming in for rent and a $1,330 mortgage payment, Jake is looking at a beautiful $470 monthly paper profit. Meanwhile, Marcus takes his $50,000 and quietly drops it into a total stock market index fund. He sets up a $300 automatic monthly contribution, meaning zero leverage, zero tenants, and zero keys to hand over. Jake grabs a tangible asset, while Marcus just quietly sets up an automatic drip. Section 2, real estate, the second job. Now, Jake quickly discovers the massive social proof of being a landlord. People are super impressed at dinner parties. But let's uncover the reality of what it actually takes to maintain that rental property when the party is over. Here is the absolute truth for young professionals trying to climb the corporate ladder. If you already work 50 hours a week to build your career, you need to understand that active real estate management is basically buying yourself a second, completely uncompensated part-time job. It's not just an asset sitting on a shelf. It's a living, breathing business that requires your constant operational sweat. Let's look at the hidden math reveal here. In Jake's first 3 years, he collected an impressive $64,800 in rent. After his mortgage, he has almost 17 grand in gross cash flow. Awesome, right? But wait, subtract the property taxes, the insurance, a $1,200 water heater, a $2,800 roof leak, and just one single month of vacancy, and suddenly Jake's impressive napkin math violently shrinks. Over 3 years, his actual net cash flow is just between $2,000 to $4,000. And remember, he did his own property management to quote-unquote save money, which basically means he spent his lunch breaks coordinating plumbing repairs. And the really crucial point here is that active management means sudden, unpredictable gut punches. You're on the hook for expenses that simply cannot be deferred. We're talking about a $7,000 HVAC replacement hitting right in the sweltering heat of August, right when your tenant is threatening to move out. You just don't have the luxury of waiting until next month's budget clears. Everyone loves to brag about the gross rent check at the neighborhood barbecue. But when you carve out the mortgage, the taxes, the 1% to 2% you absolutely must budget annually for maintenance, and that inevitable 1 month of vacancy a year, the actual profit slice left over for your own pocket is shockingly thin. Real estate forces you to constantly feed the asset just to keep it alive. Section 3, stocks, the invisible machine. So, while Jake is spending his lunch breaks fielding plumbing calls and dealing with contractors, let's look at what Marcus is doing, or more accurately, what he's not doing. Marcus treated his investment like planting a seed. There's a great saying, real estate is a business you operate, but stocks are a machine you plug in. For Marcus, his investment requires exactly 0 weekends, 0 10 p.m. emergency calls, and literally 0 effort. He's relying entirely on the extreme patience of compounding. Watch how this builds over time. For the first few years, Marcus has literally nothing to brag about. His 50 grand slowly inches up. It honestly just feels like a boring number on a screen. But by year 7, he crosses the $135,000 mark. The astonishing, invisible power of compound interest is gripping the portfolio. His past gains are now generating their own new gains, accelerating his wealth without a single hour of extra labor. The foundational divide between these two young professionals isn't just about the mathematical rate of return. It's a stark contrast in their daily lifestyle. Jake's wealth is tangible, sure, but it grows really slowly after real-world expenses and demands a massive chunk of his mental bandwidth. Marcus's wealth has zero social proof. Nobody cares about his brokerage account, but it grows on an accelerating curve and frees up 100% of his mental energy for his actual career. Section 4. The 20-year reality. All right, let's fast forward 2 decades. That's 20 years of Jake's stressful, active management and 20 years of Marcus's boring, passive waiting. Who won? Prepare for your stomach to drop a little. After 20 years of sweat, leveraging bank debt, fixing roofs, dealing with turnover, and keeping the property afloat, Jake's total equity sits around $450,000 to $500,000. Meanwhile, Marcus, with his totally passive index funds and $300 monthly drips, his net worth is sitting at roughly $420,000 to $460,000. They are practically in the exact same ballpark. Jake worked endlessly for his wealth, while Marcus simply waited for his. This proves that picking an investment strategy isn't really about finding some magical wealth hack. It's fundamentally about choosing the lifestyle you want to live in your 30s and 40s. Do you want to be a business operator on the weekends, or do you want your time completely unchanged? Oh, and there is a critical multiplier effect here. If Marcus had simply increased his automatic contribution by just $200 more a month, his 20-year portfolio would effortlessly jump to an absolutely mind-blowing $600,000. It scales perfectly. For Jake to scale his wealth, he can't just click a button. He would literally need to take on a whole new massive mortgage, find a new property, and double his weekend workload. Section 5. Exam Review, Evaluating Risks. Now, before you commit your hard-earned 50 grand, let's summarize this explainer with a final exam review. It's time to make sure you thoroughly understand the brutal, often ignored risks hidden within both methods. Let's pull out the pop quiz. First up, real estate. You have to accept that you're taking on severe concentration risk. Your entire fortune relies on one single asset in a single zip code. It's totally illiquid. Your money is trapped in bricks. You have capital expenditures that are guaranteed to fail. Roofs and furnaces always break eventually. And the most terrifying reality? One bad tenant who stops paying and knows the local eviction laws can cost you up to 6 months of lost rent and legal fees, instantly erasing an entire year's profit. Conversely, let's examine the stock market. Influencers love to gloss over the gut-wrenching volatility. In 2008, the market dropped 37%. In March 2020, it plummeted 34% in just weeks. Watching your 150 grand drop to 95,000 is psychologically agonizing, and human nature will completely scream at you to panic sell. Furthermore, you have virtually zero cash flow to spend today. You can't use massive bank leverage to supercharge your buying power, and you definitely cannot use legal tax magic like depreciation to shelter your income. So the crucial point is this. As you prepare to deploy that first $50,000, do not fall into the trap of blindly following a catchy headline or taking the advice of your loud uncle at Thanksgiving. Run the full numbers for your own life. Weigh the actual hidden costs of your precious time. The next time someone guarantees you that real estate always wins or that index funds always win, I want you to ask them a very simple, provocative question. Did you actually include everything? Because in the real world of building wealth, the only math that matters is the math that accounts for reality. Keep learning, keep questioning, and choose the path that builds the life you actually want to live.